Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 35 on November 9th, 2018. I'm your host, Eric. And in this week's show, we will cover the trades from last week on Petro Brasil, the QQQ ETF, and Mylan Pharmaceutical. And then we'll discuss three new trades on Dropbox, American Airlines, and Twitter. Now, it's always great to hear from listeners. So if you have any questions about the trades presented here on the show or about your own positions, feel free to email me. You can reach me at eric@theweeklyoption.com. That's eric@theweeklyoption.com. I've also created a video series to teach you all the basics of option trading that you'll need in order to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit our YouTube channel, the channel for the Weekly Option. Now, this past week was big. We saw the midterm elections. There was a lot of political movement and news, and that's why I mentioned it in the last show, just to be abreast or stay abreast of any changes in the market, especially around sentiment with regards to the outcome of the elections. So the Dow Jones Industrial Average actually had another strong move higher this week, rising 718 points to finish the week at 25,989 points. The S&P 500 index was 57 points higher, ending the week at 2,781 points. Both indices were up a bit more than 2.5%. Now, this upcoming week, there are 428 publicly traded companies announcing their earnings here in the U.S. On Monday, the steak restaurant Del Frisco's will announce their earnings. On Tuesday, we will hear from Home Depot and Tyson Foods. On Wednesday, I'll be watching for Macy's results. And then on Thursday, we'll hear from Nordstrom's as well, so we'll get both of those retailers. And then on Friday, we'll hear from Williams Sonoma. Now, there obviously are quite a few more companies than the ones that I just list here. I just try to give you guys an idea of the ones that I will be taking note of, or some of the companies that you might be familiar with that will be announcing earnings this week. So with all that being said, let's dive into the results of last week's trades. So the very first one was a covered call on Petro Brasil, symbol PBR, Paul, Brian, Richard. At the time, the stock was $16.13 per share, and I looked at selling the November 16-half call for 67 cents, which would have been a 6% return in 2 weeks. So the result of that is that Petro Brasil, actually, their stock fell $1.19 this week, finishing the week at $14.94. So the call option you sold fell 60 cents, leaving you with an opportunity to buy it back and actually lock in some profit on the option. Now, you lost $1.19 on the stock, so this will bring your combined loss down to 59 cents per share. You can then look at selling the December 15 call for 95 cents, which will give you a chance at finishing with a 42 cents per share profit. That's 6 cents from the stock move from $14.94 to $15 per share. And then that would be 36 cents additional profit that you collect by selling that December option. And since you're selling the December option for 95 cents, I subtracted the 59-cent loss from the stock move that you've already received. So this is just one of those ways where if you understand options, you might find a way to turn a loss into either a smaller loss or actually turn it into a profit. So have a listen to that again. If you have any questions, of course, you can email me, and I'd be happy to just walk you through in more detail if you need. Now, the credit spread that I'm looking at, or that we looked at last week, was on the QQQ ETF, and this is actually the ETF for the NASDAQ, technology index. So when we looked at the trade, the stock was trading for $169.38 per share. And I looked at selling the November 173 half call spread for 16 cents. And since it's a 50-cent wide spread, your maximum loss would have been 34 cents. Well, we sold a call spread and the triple Qs rose $2.14 per share this week. So you finished the week at, it ended the week at $171.52. Now we sold, since we sold the 173 half call spread, we're still safe. Our break-even price, which is of course the point at which you have neither made nor lost any money, it's your 0 point. So our break-even price on this trade is a stock price of $173.16. And as long as stock finishes this upcoming week lower than that, then this will be a winning trade. So that's, $1.64 higher than the current stock price. So we're obviously happiest with stock staying below $173 per share, because then we get to keep the entire 16 cents that we sold the spread for. So 16 cents on 50 cents worth of risk is a roughly 32%, or it is a 32% return on the value of that spread. So I'm always happy with that. Getting I seek at least 30% in my credit spreads. Ideally more if you can, but 30 to 45 cents or 30 to 45% tends to be the sweet spot. Anything more than that, normally there's something else going on. And the reason why, I didn't explain this last week, but the reason why with stock at $169 per share, the reason why I didn't look at the 169 half, 170, or the 170 a half, or 70 a half, 71, so forth. The reason why I went all the way out to 173 and $173.50 for this call spread is because I wanted to still give the stock some room to move, give it a little cushion to breathe, while I still get to make the amount of money, the amount of return that I'm seeking on that amount of risk. So far, of course, with the stock still going up more than $2 this week, we're still making money on the spread. So the spread will be rising in value. So it's going to look in the market like it's worth more than 16 cents, but the spread only has one more week left, because this upcoming Friday, November the 16th, is November expiration. At that point, any options that are out of the money expire worthless, and anything that's in the money will expire with the intrinsic value. That's pretty much it. So right now, even though stock moved against us, we still are in a sweet spot. We're still in a good position for this trade. So I wouldn't make any adjustments to it at all. And then the last spread was the debit spread. This is the spread that I bought on Mylan, a pharmaceutical company. Its stock symbol is MYL, Mary Yellow Larry. Stock at the time was $31.68. I looked at buying the November 32 put spread, paying 35 cents for the spread, and hoping for a maximum gain of 15 cents or 43% in 2 weeks. So I kind of have to breathe in and exhale on this one. This was one of the biggest reminders of an old lesson that I learned a while back. I got to relearn it this week. Because back in the day, I used to trade a biotech called iTech. And iTech, I ultimately made some money on those options when I was on the floor of the CBOE. But it certainly brought probably more stress than it was worth, because of FDA approvals and uncertainty around, various stages of drug approvals. So that being said, that's all foreshadowing, or really it's me prolonging the fact that I lost money on this trade. So certain industries have nuances that you must be aware of in order to not get your face ripped off. This Mylan stock rose $5.27 this week, closing on Friday at $36.95 per share due to a positive FDA approval for one of its drugs. That being said, the trade is obviously done. The beauty of this is that we bought the spread and knew our maximum risk right from the start. Now, unfortunately, with prices here, with stock right here, we lose everything we pay for the spread, but our loss is limited, and resize the trades. We always size the trade to a risk size that's appropriate for your portfolio. So I never want any single trade to take me out of the market, right? So you always plan your trade so that no single loss breaks you and you live to trade another day. So imagine the pain or the damage you'd feel if you looked at the stock chart that I saw last weekend and said, wow, this would be a great stock to just short. Like, I don't want to buy a spread, or I don't want to sell a spread. I just want to short the stock and make more money faster. You would have gotten lit up with a $5 per share loss in a matter of days. So that's one of the pluses to trading option spreads as opposed to even naked options or stock, is that right from the start, I know what my maximum gain, I know what my maximum loss is, and I can plan and size the trade accordingly. We are officially 1 week away, like I mentioned, 1 week away from November expiration, which is this upcoming Friday, November the 16th. At expiration, all November options will be worth their intrinsic value if they're in the money, or they will not have any value if they're out of the money, and they'll expire at zero. So this week we will start focusing on December trades. So we'll start off with the covered call like we do each week. This time I'm looking at Dropbox, symbol DBX, David Bryan X-Ray. The stock finished on Friday at $25.55, and I'm looking at selling the December 26 call at $1.35 per share, and I would sell that against stock that I own or purchase. I'm hoping for a 7% return on my money in 4 weeks. So you would enter this trade by buying Dropbox stock for $25.55 per share, unless you already own the stock, at which point you could just sell the call against the stock. And then the next move is that you would sell the December 26 call at $1.35. So Dropbox had strong earnings last week, and the stock price has been really looking like it has a lot of strength to the upside. So I'm comfortable owning the stock as well as selling this call against it to create the covered call, and 7% return isn't bad in 4 weeks. Next spread that we're looking at is a credit spread on American Airlines, symbol AA, Apple. The stock finished $34.36 on Friday, and I'm looking at selling the December 35-36 call spread at 30 cents. That would give me a maximum loss, or a maximum possible loss of 70 cents. Now, you would enter this trade by selling the December 35 call at $1.75 and then buying the December 36 call for $1.45. This is a credit spread because we are ultimately selling the spread. Since it's a call spread, we're selling the lower strike call We're selling the lower strike call and then buying the further out of the money call. This trade makes money if stock prices stay below $35.30 per share. Our final trade for the week is going to be a debit spread on Twitter. Twitter symbol is TWTR, Tom, William, Tom, Richard. The stock finished on Friday at $34.08 per share, and I'm looking at buying the December 36-35 put spread for 66 cents, hoping for a maximum gain of 34 cents or 51% return in 4 weeks. Now, you would enter this trade by buying the December 36 put for $3.15 and selling the December 35 put for $2.49. This is a debit spread because we are buying the spread, and this trade ultimately makes money if stock prices stay below $35.34 per share. Now that's it for the week. If you have any questions, of course, feel free to email me at eric@theweeklyoption.com. And I look forward to having you guys on next week's show. And we're going to continue this journey where we get to talk about trading, and hopefully you get to learn a bit along the way. So that's it. Have an awesome week. Happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.